Due diligence. From my experience, most buyers think about due diligence as what they're going to do after they write a letter of intent. And although those activities are really important and can include financial, contract, legal liabilities, and customers on a deep dive, what they're missing most of the times is the pre-letter of intent due diligence that a buyer should be paying close attention to help them write the deal structure and put a letter of intent in place. So if you're a buyer thinking about purchasing a company, in this episode we're going to talk about pre-letter of intent due diligence and post-letter of intent due diligence. And they're not necessarily the same, so stick around. As always, if you've got questions as I go through this episode, please leave them in the comment section below or send me an email and we'll get together and talk about what is ever on your mind. In addition, if you get something out of this episode, please consider hitting the like and subscribe button. And with that, let's talk about due diligence. Now, when I think about due diligence or approach due diligence representing a buyer, I really think about it in two segments. The first one is pre-letter of intent, and the second one is post-letter of intent. Now, before you actually move forward, the other thing that I think about is the size of the transaction. Now, why does size matter? Well, size matters in the trusted advisors that you may have to bring into a transaction. If you've done a merger and acquisition or bought a business before, you can understand the complexities of a $15, $20, or $30 million business and the expertise needed to go in and do the due diligence that's going to be required. If the transactional size is $10 million or less, you can probably get away with one or two advisors to go through due diligence and help you purchase that company. So let's talk about pre-LOI. Due diligence, pre-letter of intent. Now let's talk about why you would actually do or think about due diligence in a pre-letter of intent. And the simple fact is you're trying to get enough information from the broker or seller or merger and acquisition advisor to actually put together a really comprehensive letter of intent, an agreement between both parties for price, terms, contingencies, things like lease, training that needs to take place, and transitional issues. So knowing as much as you can up front is going to help you structure a transaction that's going to work for hopefully both the buyer and the seller, but guards you down the line when you get into other due diligence post letter of intent. So with that, let's talk about the non-financial aspects of due diligence. First, owner's reason for selling. And it's important to understand why the seller is selling. Are they of retirement age? Have they had another opportunity, or was there a life event? So understanding their motivation is going to give you some leverage in putting together a letter of intent that works for both parties. Company history. Now, a company that's been in business for 20 years and has actually been sold once bodes really well for the company that you're probably looking at. That speaks volumes in that the company has survived the ups and downs over a 20-year period and the transition of ownership from one owner to another. And the next one is products and services. Now, don't give this just a cursory glance, but truly understand the products and services that the company offers, a little bit about the supply chain. Do they have any vendors or licenses that are really important to what they do? And if so, you probably should dig a little deeper before putting a letter of intent together. Processes. written processes around if they're a manufacturer, their manufacturing process, and if they've got a sales process, really understanding that. The sales process can be really important. A great example is I sold a granite and marble kitchen counter top manufacturer and installation company a few years ago. And in their bid process, they automated it, had one person in charge of doing all of those bids. And so the owner wasn't stuck doing the bids. But they did enough bids on a daily basis where it was pretty easy for them to get behind. And because they had an automated process with written process and procedures, it was easy for them to bring in a second person, clear the backlog of bids, increase the bids won, and really drive some extra volume. So understanding that sales process and how it evolves is really important. And if they've got written process and procedures, you want to take a good look and really understand them. Who their customer is, the target customer, is really important for you to understand as far as where they live, the demographics of that customer, and then talk about customer concentration. If this is a B2B, if any customer's got more than 10% of the business, it's not necessarily a big red flag, but if that customer is their top customer year over year over year, that's a little different than looking at a 3-year history where one customer may raise to that 10 or 15%, 1 year go back down to 5 or 7%, and another customer replace them. So understanding a customer concentration over a 3-year period and taking the top 5 customers and just kind of mapping it out is something that you should do, or you should ask the broker for. Facility. Again, this is, if they're a retail operation, could be very important to the location. If they're a manufacturer or a service company and don't have clients coming to their facilities, that's another thing altogether. But if you want to take a look at the facility lease, look at the terms, the assumability, and what's going to be required for you to assume that lease. Next, key employees. Now, key employees can really help drive the company, and you want to understand if there are 1 or 2 key employees. Do they know the business is for sale? Are you in danger of them leaving the company? If the company's sold, what are the seller's thoughts on that? So you really need to understand who's driving the business. And then last on this non-financial checklist is, after you've gone through all these, you'll be able to answer the question, is the owner the business? i.e., you're buying the business and not the owner. Has the owner put enough infrastructure in place to where the owner can gradually step away and you can come in and put together a smooth transition? So non-financial due diligence is really important, and you need to kind of go through and develop this checklist to answer these questions before you get to financial due diligence. Financial due diligence, pre-letter of intent. Now in this section, you're not going to dig like you are in due diligence, post letter of intent, but what you're trying to accomplish is to understand the trends of the business on a financial basis. You're also trying to verify or confirm the broker or the seller's recast and the reason that they're justifying the purchase price that they've put forth. So to do that, we really encourage you to get at least at a minimum 3 years tax returns and internal financials, which is a profit and loss and balance sheet. If possible, get 5. And when you spread them, what you're looking for is revenue year over year. Is it growing? Is it staying the same? Is it intermittent? Or is it decreasing? So understand that trend analysis, the cost of goods sold, gross margin, operational costs of the business, and then net profit before any add backs. So you want to identify those and take a look at the ratios as a percentage of revenue for each one of those to take a look if you've got a healthy business. Now, on the broker's recast, what you're also looking for here is the reasonableness of that add backs. So when we do valuations, what we're looking for are interest, depreciation, amortization, seller or owner's compensation, which includes health insurance, life insurance, if they've got a car allowance or some of those type of personal perks can be added back. And to that, that'll give you the actual cash flow if the seller was absent from the business. And then you can apply a multiple or a range of multiples to come up with justification of the purchase price. Balance sheet's a little bit different. You want to understand what's coming with the business and what's not coming with the business. And that can include cash, accounts receivable, inventory, work in process. So understanding the makeup of that and what's coming with the business versus what's leaving the business. And then when you're thinking about working capital, think about running a 12-month working capital ratio. You'll need the past 12 balance sheets to do that. And we've got an episode that talks just about how to calculate that, and I'll include that in the link down below. But take a look at that, because what you don't want to do is close the business and then have to bring more capital to the business after closing. So again, understanding what stays and what goes is really important. And then one thing that I always am interested in when I'm talking to a seller is how long does it take to actually close your books? And if they say, gosh, it takes us 30, 45 days, then you may want to start thinking about how efficient or accurate those books are. Most businesses that have efficient close, month-end close, can close in between 7 and 15 days. So you want to understand the ratios, the trends, the reasonableness of the add backs. You also want to think about what's coming with the business, the working capital requirements, and just how efficient they actually are as far as closing their books. Congratulations, you've got a letter of intent, and now you're ready to jump into due diligence in earnest. So again, if the broker or M&A advisor has provided you with an offering memorandum and a data room to back it up, a lot of these things may already be in there, but if they're not, you need to develop a checklist and send a request off to have it populated with the data that you need. So let's start with the non-financial due diligence and go back to products and services. Now in this segment, you really want to talk about or look at the supply chain. And particularly if you've got a vendor or a supplier that's integral to either the product or the services that you supply, you want to take a look, do you have a contract? And if so, is that contract assumable? Do you have to serve them with notice of a transfer of sale, or do you have to get consent? And those are really important things that are going to allow this relationship to continue. The other thing you need to take a look is pricing. Is there a price fixed in that contract for a period of time, or are you just subject to market pricing? Again, things that you should consider and understand in that product services issue. Distribution. Again, if you've got distributors that are distributing your product and services, same thing on that contract evaluation, consent versus notice, pricing and duration, and assignability or assumability of that contract with that distributor. And then finally, if you've got a manufacturing company, think about product development. Do they have a product development pipeline? Are they working on the next products and or services that they're trying to bring to market? It's important to understand that. Obviously, this is an opportunity to continue to grow sales and revenue. Next, you want to take a look at contracts or the leases that are with the company. And again, that's just contracts around customer contracts, equipment leases, And again, you're looking for, are they assumable, consent versus notice. And really the issue around consent is that prior to the close of the sale, you'll actually have to get the contract holder, the other person, to consent to you assuming this contract. If they don't, you may have to enter into a new contract that could be a pricing issue, could be a duration or a product and services. And I've run into an issue in the past where the company that held was on the other side of that contract would not consent to a sale without the selling company giving up its intellectual properties. And in this case, it actually killed the transaction. So it's really important to know who's on the other side of those contracts, especially with products and services, supply chain issues, and if they're assumable, consent versus notice, and pricing issues that go along with those contracts. The next thing you might want to take a look at is your employee base. So get a list of your employees, their hire dates, their job titles, salary versus hourly rates, and a couple things that I would look for in taking a look at this section. And it's really the age of the employees. How long have the employees been there? If you've got long tenured employees, that says something about the company and the current ownership. If you've got constant turnover in your employee base, that says something else. So take a look at that and take a look at obviously key employees as well. Benefits. Are there benefit packages that you can assume? Are there the benefit packages that you would use? There could be medical, 401k, and usually those are all easily assumable, but it may be a good option or opportunity for you to go out and price new contracts, whether it be medical or 401k. Take a look at the vacation policy. What is it? Do they have an employee handbook? Is it up to date? Do you have all the notices, both state, federal, and local, posted? Do they have a service to provide that? So those little things start to add up and can make a difference. And then payroll service. I think it's really important to understand the payroll process. Any employee, I don't care what level, golden rule is you never mess with their payroll. So make sure their payroll is done on time, accurate, and they get it either a check or direct deposited and done seamlessly. So take a look at who's doing payroll. Are they the owner? Is that going to be an issue that you're going to have to take on or train to, or have the owner stick around and transition that service over? So on the non-financial side, you're looking at the products and services, your supply chain, contracts, assumability, and liability on those contracts. Financial due diligence post letter of intent. Now, again, a little bit of repeat from the pre-letter of intent due diligence, but what you're looking here is to take a deeper dive. Let's start with the profit and loss statements of the company. So, most small businesses, what I recommend is a 2 to 3 month spot audit. And so you want to pick 2 or 3 months at random, get the individual profit and loss statements, and then get the bank statements that correspond with that month, as well as the credit card statements, and do a reconciliation and see if the revenue adds up, that you can track revenue deposits or transactions that equal the revenue on the profit and loss statement, as well as take a look to see how the checks were cleared or any credit card statements were cleared as well. And you should be able to get a real idea how well that process is done, whether they're accurate, if you've got inconsistencies. And again, they don't have to match to the penny, although they should, but the difference can be between accrual and cash accounting in an internal profit and loss statement. The next thing you want to do is take a look at the balance sheet. Again, we talked about working capital, but I would spread 12 months and I would take a look at that working capital. And working capital is really calculated as the difference between cash, accounts receivable, inventory, work in process, minus accounts payable, work in process, credit line, or any other liabilities, current liabilities associated with cost of goods. So take a look at that, and you should have, for most businesses, a working capital ratio of 1.5 to 1. Now, that's 1.5 worth of assets, current assets as I just described, to every dollar of liability. And if you've got that, then the cash flow process, how their sales process works, and the company should be able to support itself and produce the profitability that it's been historically producing. If you don't have that, if it's less than 1.5 to 1, then you need to dig deeper and understand if you may have to bring additional capital to close after you close, or if there was a line of credit that was used and how often that was used. So take a look at those. Accounts receivable aging. So what I would do is get an accounts receivable aging report for the last 12 months. And again, what you're looking for is accounts receivable that have not been collected past 60 days. So that's 60 to 90, 90 to 120 and greater. And to think about what that looks like. And if you've got 5 to 10% that's past that 60 day plus, you want to pay attention to who those clients are. Maybe it's the same customer. Maybe it's a process or procedure internally that's not being followed that allows those to get to that past 60-day mark. But whatever the reason or whoever the client is, you want to have a better and deeper understanding about that. Also, you want to think about bad debts. Historically, what has the company written off that they've been unable to collect? And if it's, 1% of revenue, or, if it's something small, I wouldn't necessarily worry about it. And if it's, you can take a look at the tax returns to figure this out, the bad debts right on page 1. But you can take a look at that to see if there's a consistent trend and if they've reserved for bad debts on the balance sheet. Again, it's just the process of collections, it's the process of the customers they're dealing with, so get a better idea of what that looks like. Asset list, especially if you've got a lot of equipment, you want to take a look at the life expectancy, the condition of those assets, replacement costs, and then if they've got any large pieces of equipment where they've got service contracts, you want to take a look at that history of those contracts and how well those equipment's been serviced. And again, really around life expectancy and capital issues for you if one of those pieces were to go down. And then last, inventory. And what you're looking for here is obsolete inventory that may be represented on the balance sheet. And so take a look at inventory adjustments over a period of time. You'll also want to know when the last inventory, physical inventory, was taken, and do they have actual records. I cannot tell you the amount of small businesses where I've seen on the balance sheet, we get to the inventory section and the seller's like, I haven't done an inventory in 5 years. I'm just kind of guesstimating on my inventory. I would make sure that if you're a buyer, that you do a inventory at close and that you have a post-close representation in the letter of intent to adjust for those numbers, whether they're obsolete inventory or whether the inventory is just off. So make sure that you really focus on inventory, obsolete inventory, and when that last inventory was actually taken. So with that kind of covers that financial aspect. Obviously, financial due diligence is really subject to the structure of the company. If it's a manufacturing company, a distribution company, or a sales of services company, the due diligence is a little bit on each. But at a high level, this is what you want to take a look at for due diligence. Due diligence, both pre and post letter of intent, are equally as important. Having that due diligence put together up front in a systematic way will really enable you as a buyer to put together a letter of intent that protects you going forward, and any post letter of intent due diligence will be just to confirm what you found out up front. Now, I can't speak highly enough of the brokers and M&A advisors that do a really good job putting an offering memorandum together and then backing it up with a data room. It'll make your job just that much easier in doing it. I've enclosed in the comment section below a couple links to various episodes that I've done in the past. Working capital, SDE versus EBITDA, and seller's discretionary cash flow. And then one on if it's better for you as a first-time buyer to hire a broker to assist you through this whole process. They may be well worth your taking time to take a look at them. I hope you got something out of this episode, and if you did, hit like and subscribe. And with that, we'll see you on the next episode.